Perfect. Thanks, Marty. Yeah, so Will Stringer, co-founder, CEO of Chisos and Chisos Capital. My background, banking, and then spent majority of my career at a family office in Houston, Texas, working on the investment team, working across assets, kind of understanding some of the attractive asset classes to family offices. Spent some time at a fintech and an operating role before ultimately starting Chisos. And what Chisos does is invest directly in people. So as Marty said, it's taking a little bit of a different approach to the early stage venture world, really investing before angels, before pre-seed, before any VCs. So what we like to say is that Chisos Capital unlocks talent. And the way that we do that is by investing where nobody else is providing capital. So today you go to start a company, and if you don't have personal wealth or maybe a wealthy network, you're kind of out of luck, especially if you don't have an MVP or some kind of traction with your company. You know, banks going to lend to you, angels and VCs typically want to see some kind of traction. So that's kind of the valley of death that you get stuck in. And so there's a couple tailwinds here that we think are really going to drive this trend. So you have the Great Resignation. You have people quitting their jobs, starting companies, basically thinking about their careers and what they want to do. That nature of work is changing. So instead of going the 9-to-5 route, creating your career, going up to the ranks of a company, people are either starting a company or starting some kind of side hustle business, whether that's a newsletter, a Twitch stream, a YouTube stream. These are viable ways to make a living today and really build an audience and make a lot of money. Coupled with that, entrepreneurship on the rise. You know, you have these inflated valuations that have been talked about if you're investing, you know, as a VC or even in the public markets. And so all of this kind of leads us to believe that this investing directly in people is an excellent way to get exposure to talent and exposure to that talent's businesses and what they're building. So the way to think about this kind of looks like venture debt at the very earliest stage. It also looks like revenue-based financing, if you're familiar with either of those asset classes. But this revenue-based financing is for individuals. And so if anyone's familiar with income share agreements, which have been used in the education space for about 5 or 6 years, we're taking that instrument and using it for entrepreneurs. And we're combining it with a safe or equity in that entrepreneur's business. So it's really two streams for us. Day one, we're getting an income share agreement, really backed by that founder, acting as a personal guarantee, and we're getting equity in their business so that we can win if their business succeeds. If their business fails, we'll also get paid back through this income share agreement by betting on the person. So this is just kind of a graphical representation of what that looks like. Two instruments combined into our terms, which are called a convertible income share agreement. The example I like to give is Bezos in the 90s. So he was a hedge fund VP. He had a good salary, presumably good future earning potential. When he went to start Amazon, he actually took on outside investment. Now, he was lucky enough to have some friends and family that could provide that capital. That's not the case for many talented entrepreneurs. They can put in a little bit of their own money. Maybe they raise a little bit of friends and family money, 20, 30K. But oftentimes they're going to need another 30, 40, $50,000 to complete their minimum viable product or to start gaining a little bit of traction before they can ultimately raise their next round of capital. And so in this example, $50,000 investment from Chisos via the convertible income share agreement. Amazon succeeds, we get paid back through the income share agreement as Jeff pays himself a salary. We also have—
So wait. The income comes from the individual back to you?
Correct.
Or through the company?
It's based on the individual's personal income, W-2, 1099, K-1. So the company could be making, $1 million in revenue. The founder's not paying themselves over a certain threshold, and they're owing nothing on the income share agreement. And then in this example, Amazon fails. Jeff goes back, gets a job at another hedge fund, and pays back the income share agreement over time as a percentage of his gross personal income providing us with cash flow and return, even though the business failed.
Do you cover any future optionality on other ventures if the first one fails?
Today, we don't, no. If their first venture fails, that equity will go to zero, and then we'll just hold that income share agreement with the individual.
And that's it. So if they hit like a grand slam in the fifth venture after 4 failures, you guys derive nothing other than the individual's income stream.
Contractually, that's correct. We have kind of a later stage syndicate that we've spun up, and we'll have a relationship with that founder. And so presumably as an early backer of them as an individual on their first venture, they would give us some kind of allocation in later ventures. And we'll get to watch them.
And do you get an
progress.
equity carry in their enterprise?
We do, yes. Yeah. So let's say traditional investment, $40,000. We get an income share agreement, let's say with you personally. And so when you're earning income over $40,000 a year, you pay us 10% of your gross income on a monthly basis. That's the income share agreement. You will also grant us through the company a safe worth anywhere 1 to 5% of the company to begin with, depending on where they're.
With a cap or with a cap or no cap?
So it's capped. It's basically we're targeting a percentage. So instead of it's a dollar amount with a cap, we're saying, hey, at your next round of priced equity or whenever the safe converts, we get a specific percentage.
Pre-money.
Post-money percentage.
But that, and
Series A will agree to that?
It's essentially the YC safe. We've just had to convert it to a specific percentage instead of a dollar amount.
and you don't give them any further capital for that safe. It's tied to the income guarantee.
Correct. It's a single check and it's a tri-party agreement. So it's
you get the carry for free, basically.
for free.
And
Yes.
is the income sharing is that does that carry an interest rate, or is simply repayment of capital over time?
It's simply repayment of capital over time. Now,
So your risk is on the equity side in terms of in lieu of interest on the money advanced.
so since there's no interest that compounds, the income share agreement is classified as a financial contract instead of a credit instrument. And so basically similar to the education space, we say you pay us back 10% of your gross income until you hit a 2x cap. So we'll make money, and our ISAs, income share agreements, are underwritten to about 12 to 15% return on a standalone basis. And then the equity is kind of additional gravy or additional upside on top of that. And so, because we're working with such early stage entrepreneurs, early stage talent, we are building out a resource platform as well to surround those entrepreneurs with advisors, introductions to upstream investors, service providers, everything that could basically help them become more successful or have a greater chance of success while building their business.
And who vets these people?
The resource providers.
Yeah, you've got a bunch of potential entrepreneurs. How are you staffed? A, to make yourself known to a bunch of entrepreneurs out there, number one. And number two, who does the assessment of the entrepreneur's potential?
Sure, yeah, I'll jump to that. So we've basically built an automated front end that starts with an open online application. And so we're sourcing opportunities from really two main avenues. One is traditional marketing. So we're out there, social media, blogs, forums, hanging out where entrepreneurs are today and where they're learning. Two, we're partnering with accelerators and incubators across the United States to tell them, this is what we do as Chisos. You're going to see a ton of opportunities that are too early for you or not a good fit. Send them over to us. We'll underwrite them, hopefully make an investment. And that way you can be helpful to them instead of just saying no.
So a lot of early stage VCs could be sending you prospects with the idea that once they graduate through your system, that they become material for themselves.
Exactly. Yep. In the process, like I said, we've tried to automate as much upfront so that we get a litany of information on the founder and the business that is submitted to us. We kind of pre-qualify some of the opportunities looking at the founder's credit profile, the founder's qualitative and psychographic profile, trying to look at things like grit, hustle, ambition, entrepreneurial traits. After they're pre-qualified, that's when they go into the more manual diligence phase, which is basically high-level diligence on the company. So they're very early companies. Often there's not much there. We're just trying to check the boxes to make sure that the entity exists, that they have a viable go-to-market strategy, a viable idea of what it is they're building. If it checks all of those boxes and we like the opportunity across both the founder and the business opportunity, that's when we'll make the investment. And so, yeah, we're using technology to automate that front end, automate as much of the process as possible so that we can deploy this capital at scale.
And what's the maximum you would provide to anyone in entrepreneur?
Our maximum check today is $50,000.
And that capital is provided by your limited partners?
That's correct. Yeah. Today we raised, I'll kind of go into the traction here. So we raised a first pilot fund in January of this year. That was $500,000. That is now fully deployed into 13 or 12 opportunities. We have since collected close to $50,000 back in income share agreement payments. And we'll be making our second distribution in 12 months to our limited partners in January. And so today we have 3 opportunities that are providing current cash flow to us because they have income either from their startup or from their primary job as they're working on a side hustle business. They have income that's providing us payments through these income share agreements. So there is a current cash component of this as we move forward. And for our fund 2, we're warehousing a number of deals before we have our first close. 4 out of those 5 opportunities have primary income, have day jobs, and are thus providing cash flow on the income share agreements. So it's a cash flow instrument with that equity upside, similar to.
So you're putting together your second fund right now?
That's correct.
And what are the parameters of that to the LPs?
So it's fairly standard fund structure.
220?
So the fee structure is more debt centric. So there's an origination fee when capital goes out the door, and then there's a servicing fee when capital comes back. So there's no annual management fee. It's fee on capital out, fee on capital back. And then there's a percentage share on the equity piece. So if there's an equity exit or liquidity event, then we'll have a 20% share of that liquidity event.
And what size is this fund prospect?
So this fund size is going to be a $5 million fund. Yeah, and we'll be looking to hold our first close before the end of the year.
So you have 5 candidates for the fund?
We have 4 deals that have been completed for fund 2. Our 5th one, we have the documents that are out.
Okay.
And then we have another 5 deals kind of waiting at the gate for us to get our first close to make those investments.
What are the numbers that you look at to get yourself down to 5?
Mhm.
Are you look like, is this kind of like a baby seal assessment process, or easier or harder?
Today, it's about 100 applications per month. I'd say that is, I think in the next few months, we can get to 300 applications per month. We will actually dive into probably anywhere between 20 and 40% of those to actually take a little bit of a closer look.
Yep.
And then we'll ultimately invest in somewhere around 5 to 10% as a kind of ultimate funnel.
Where are you based?
I'm based in Santa Monica, California. Our team is distributed. So my co-founder is based in San Francisco. And then we have team members in San Diego, Denver, and New Hampshire.
How are you collateral? Do you collateralize against these loans, against the assets of the company or the intellectual property or any of those things?
So on the equity side, we're treated as a standard early stage investor under the terms of a SAFE. The income share agreement is not collateralized by any hard asset, but it is a
Contract.
financial contract with claims, on their assets should they.
Is it an income share or revenue share?
It's income share, their personal income.
Oh, personal income.
Yep.
Okay.
Yeah.
So you're looking to raise 5 million and the maximum deployment is 50,000, right? So
Correct.
technically that gives you give or take a maximum of 100 deals.
100 to 150, yes.
And then based on the reverse math, you have 5%. So you have to pretty much increase your deal flow in order for you to generate that, right? Pretty much have to look at 100 times 20.
That's correct.
20 years.
That's
And
correct.
you're looking to deploy the capital within 12 months?
12 to 18 months, yes. Yep,
May I ask you a conceptual question?
sure thing.
I came in a little late, but if I understood correctly, you're a venture lender, and sometimes you lend to situations which aren't revenue really producing yet, but where the founder or the founder's family have income from other sources or from their day jobs or things like that. Some people would ask, why would you back a situation where the entrepreneur isn't 500% involved in the venture as opposed to having a day job?
So if they have a primary day job and are working on it on the side, that's the question.
That's my question.
So our view is that there is not always the availability of a founder to go full-time in the beginning to work on a startup. For various reasons, they have expenses, they have a family, they need to maintain their day job. And so for us, we've structured it in a way where that's okay with us, because if they have the day job and we make the investment, they're going to be paying us from day one out of their salary. So we'll have cash flow, and we're okay with that 12 to 15% return on the income share agreement alone. Now, the company may take longer to reach some kind of product market fit, but that's okay with us because we have the return stream through the income share agreement, which is based on their personal income.
But to my question again, why would you print? I understand you're making some money from the side cash flow. Many people would ask, why would I consider investing in a situation unless the entrepreneur is 500% involved in that 24 hours a day?
Yeah, our view is that you can build a good business on the side without being focused on it 500% a day. I think there's plenty of examples, especially in software and app type businesses, where you can get to $1 to $3 million of revenue or income working on that business on the side. And today there's more and more opportunity to exit those small SaaS, micro SaaS businesses for $10, $20 million as a side hustle business. And for us, that's great. We got in at $1 million valuation cap. They sell it for 20 million. We went on the equity side. They have a primary day job, so we're also getting cash flow on the income share side.
Especially if they're developers. If they're developers, it makes it a lot easier to pull out because they're playing with the same toolbox.
Exactly.
And it's interesting.
Do you know what
It's contrary
percentage
to.
of, do you know what percentage of your entrepreneurs move from a part-time to a full-time involvement in their enterprise? Have you had any metrics on that?
We don't have good metrics on that. We've only had someone go the other direction so far. So we had a person who we invested in who was full-time on their business. For various reasons, they had to, when COVID hit, move to the US full-time. They're a US citizen, but they were back and forth. And so they had to get a job to maintain a life and a wife in Los Angeles. And so they went and got a job as an engineer at a Fortune 500 company, and then started paying us on the income share agreement while still building their business part-time.
Do you bet primarily on the sole entrepreneur, or do you bet on the team just to mitigate your risk if you have two guys, for instance, right, working part-time based on one guy versus you have dual income on both of them now, or at least a guarantee? Would you consider that?
Yes, so we are potentially about to do our first deal where there's dual income share agreements with co-founders. So far, it's been one founder, one income share agreement, but this next opportunity, two strong founders, they're trying to get to the full $50,000 investment. And if we underwrite each of them, our scoring algorithm is telling us we can only get to 35,000 on one of them, and I think 25,000 on the other. So combined, they can get the full 50,000.
My take on that, obviously, I'm not trying to fund your business, is maybe you reduce the risk if you have two. Trust me, it's local experience. If you only have a solo guy, he yells out, or he has a wife or family, he has two kids, right?
Right.
And all of a sudden, you can use the lending, so instead of the maximum ticket is 50K, you can go up to 80, maybe 90. You have more guarantee from dual income and perhaps a better execution, because as per this gentleman, you just mentioned, maybe you have now 2 part-time guys putting in 40 hours a week combined.
Yeah.
Versus one guy who, maybe 15 will hit by plus.
You're exactly correct. And I think stats show that the rate of success is greater with 2 or more co-founders versus a solo founder.
What's your IRR target for the fund?
So IRR target grows 20 to 25% that's about a 2.8x MOIC.
I'm sorry, and the coupon is?
So the coupon's variable because it's the
What's
income
typically
share agreement, but
average?
we're looking at kind of 10% return of capital year 1, year 2 is somewhere between 10 and 15%, year 3, 15 to 25%. So it kind of ramps up as we assume that an entrepreneur either raises their next round of capital, can start paying themselves a salary, or their business fails and they go back and get a primary job. So that's why we think that it ramps up over time.
Do you really?
So credentialing the entrepreneur matters a lot.
It does, yes. Our underlying factor that we're really looking at is the future earning potential of that entrepreneur. Meaning, what do we think they're going to make? Should their business fail?
Okay, so there's like 20 Google engineers a year who go, start a company, and it's probably better to lend to them because they're going to go back to Google and make money. So
That would be ideal, yes.
all right, so I mean, it's pretty straightforward, yeah. And so come on, sorry.
You were gonna say, given that return profile, 2.8 MOIC, that puts you in a different asset class than measured capital, but yet you're relying on Series A's to give you the juice. So the investments might be VC investments, but your structure keeps you a little bit at a different, performing at a different asset class level.
So our returns are based on a pretty conservative assumption on the actual success of the companies. So we're thinking 75% of that equity is going to go to zero, thinking that 15% of the equity is going to return less than, let's call it the 1x investment. And then that other 10%, will have some kind of equity upside. So because their data is not great on this pre-seed, call it friends and family investment, point, we're going more on the conservative side as we model our equity outcomes. So, it could be greater than that because we are getting in at pretty low valuation caps, 1, 3, 4 million, whereas the standard pre-seed investor is now coming in closer to 6 or 8 million valuation caps.
So you're neither hybrid, so you're neither VC or PE, you are a hybrid. You're because if the structure is, you've got a safe on one side, you've got a financial contract on the other, and you have a return profile that doesn't easily fit into any asset class.
That's correct. Yeah. And our biggest hurdle is education on what we are and what we do.
So on the real world,
Alternative strategy.
how would you secure your default? I mean, if someone owes you 40 grand or 50 grand and they say, screw you, sue me. I
Declare
mean,
bankruptcy.
or declare bankruptcy. How do you, how do you get your return from the personal loan that you've given them, or the personal contract that you've given?
So we are utilizing a third-party ISA servicer. So they're handling the monitoring of the income, the compliance, any collection should default occur. And what they do is, after 120 days, they will actually, of no communication, they will actually send it to a collections agency. Collections agency will do their thing. And if they can't collect, it'll go on their credit report. So there is a kind of established pathway